Well, happy Thanksgiving, everybody. I hope you've all had a wonderful day or you're having a wonderful day with friends and family and the people you love. There is so much to be thankful for this year. For me personally, I wanted to share with all of you how thankful I am for all of you. Without my viewers and without all of your support, I wouldn't have a channel. And speaking of channels, I am so excited to share with you since starting my very own channel that's 100% mine in July, I am now almost back up to the amount of subscribers that I had when I broke away to start my own channel. So I am thankful for all of you for that. Let's talk about one more milestone I am so excited about. I have a bustling Discord community that is the kindest and smartest Discord community out there. I will put them up against anybody. I'll just give you a little example. So today we don't have trading going on in the United States, so you would think our Discord would be rather muted. But instead, I woke up to a flurry of messages from everyone in the Discord just talking about how grateful they are for the community that has been created for a platform for them to learn and grow in their option journey. And so many of them have found financial freedom this year and they're able to quit their jobs in corporate America like I did, and they're making life-changing money. So grateful to see all those messages of gratitude, and it just speaks to the big heart of everybody in my community. It's funny how the universe has a way of bringing like-minded people together, and it's an honor to have all of you with me every day in the trenches as we trade the markets. So last night, after market closed, I was looking at different trade setups, different opportunities to use a little bit of margin to actually have a stronger return on capital. And I found the most amazing setup that I just wanted to share with all of you so you can consider doing the same. I was able to look at a combination of two factors. One, buying shares. We're going to use Tesla in this example, buying shares of Tesla and selling a put option on Tesla that's longer date in the future to help raise additional capital. Now, that was helpful because this allowed me to produce a 36% return on capital, which is wonderful. I mean, nobody could argue with that. However, this one little tweak, actually two little tweaks of using a call option instead of purchasing the shares, so a leaps to produce the income from the growth of Tesla, coupled with selling a put option using a little bit of margin, was able to take my return on capital from a 36% return to a 95% return on capital. Now, that is wonderful because it is going to allow me to use that extra capital for other plays. Now, speaking of Tesla, for you to actually make this play, one thing has to be for certain. You have to believe that Tesla stock will rise significantly in the coming year. Otherwise, you won't have confidence going into this play, and you may make some decisions that work against you. So if you believe in Tesla, and I personally do, and I believe Tesla is so much more than a car company, I am excited about their FSD and the unsupervised driving that's coming, the robo-taxi, and the Optimus robot. Those are the things that have me super excited. Oh, not to mention what they're doing with batteries and their charging stations and everything. So there's a lot on the horizon for Tesla, and I want to invest in this company and have some plays set up for the future of my portfolio. And so if you share that sentiment about Tesla, you might be interested in this play, or you could apply this methodology to really any play that you're interested in. And then I wanted to talk a little bit about margin. So margin can be a scary word for traders if they don't fully understand it. Now, in my boot camps that I run, I spend an entire lesson on this safe use of margin, because if you are going to be trading for a living or trading in retirement, you need to be conservative so that you preserve your capital for other plays. So I'll just give you a brief thought process on margin that I use for my discipline that has helped a lot. I have margin in my cash brokerage account. Margin is the money that the broker will loan you to trade with. There's a misconception out there that immediately there is interest on that margin. But if you're using that margin to sell puts like I do, then you are not charged interest until you're actually put the shares. And if you're not put the shares, then really you just had free use of money. But you can get too aggressive with margin and put your portfolio at risk. I'm sure you've all heard of the dreaded margin call. Well, what that is it's after you have put a play on with too much margin and that play starts working against you. The broker themselves gets a little nervous if they have a lot of borrowed money out there and the play's going south. So in that situation, they will do what's called a margin call. And basically what they're wanting you to do in short order is go ahead and add more cash to the account to get back into a healthy balance, or start selling off some of your positions or get out of the position that's putting you at risk. Well, if you're in that situation, you're going to lose money because you're going to have to sell at a loss. And if you don't take action, then they take the control out of your hands and they will start taking action and closing down some of your positions to raise the needed capital. And so, with that being said, I never like to use too much margin because I don't want to lose control of my positions. And so that's important for you to understand. I think that if you don't fully understand it, it can be dangerous, but if you use it very conservatively, you're going to see how it can truly up your gains when you are trading particular stocks and you're doing certain types of trades. So let me take you into the computer, show you all the different dynamics that I want to share with you, and then you can use this to apply it to either Tesla or one of your favorite trades this week. Our first order of business before we trade Tesla is to look at the current price action and see if we are at a decent level of support. So those of you that have been with me for a while know what I look for. So currently we are at 60 on the RSI, so we're in a bullish mode for Tesla. And when that's the case, you want to look at support in this top part of the Bollinger Band. And so right now I am looking at 313 as a potential level of support. So if you want to set up a trade like this, we are nearing that level of support. If we bounce from there, then it would have served as a good level of support, but there is a chance that if it decides to push below it, then we're going to have to look at different levels of support. And the first one that comes to mind is right here at 270. So it's quite a ways away from the middle of the Bollinger Band, which is the 20-day moving average. But at this point, it looks like it may hold as the level of support. So you could try to set up your plays when you see it hit this level. Assuming we're ready to execute the play, our first order of business is buying the shares. So in our first scenario, we are going to buy 100 shares of Tesla. Now it's bouncing around between 332 and 334, so I'll use 333 as our purchase price, and I will be buying 100 shares. That's going to cost me about $33,000 to buy 100 shares of Tesla at this point. Now, to help defray some of the cost of buying those shares, I am going to go sell a longer dated put. I am looking at December of 2025, and I am settling in right here on this $350 level. For me to sell a put that is above the current price action, I have to be of the belief that in December of 2025 that Tesla's trading well above 350. And for that, I will be receiving $76.35 a share, so $7,635 by selling this put. And the broker is going to hold $35,000 worth of cash to be able to fulfill this obligation if whoever has the contract decides to exercise it. So where your risk is in this scenario is if Tesla tanks hard and is far away from 350, let's say we get into February of next year and it hits $250. Whoever holds this contract may decide to exercise it early. And if so, then I am going to go ahead and be assigned these shares. But 9 times out of 10, you don't have to worry about it that far from expiration. Typically, it is what's happening with the price action at least a few months out. But I did want to mention that risk just so you're fully aware. And if that were to happen to you, then you would just have to hold on to these shares until they recovered. So you need to be really comfortable and confident that you're okay having the shares at this level before you sell a put at this level. But for me putting up this money and agreeing to purchase the shares at this level, I am receiving $76.35 a share. So this cash that is coming into my account will help defray the cost of the shares I just purchased for Tesla in scenario number 1. Now, for part one of our scenario, let's assume we sell Tesla December of 2025, and let's say our sale price is around $505. If that's the case, we will enjoy quite a bit of price appreciation. The sale of the shares would produce an extra $17,200 in price appreciation. That's pretty cool. Now, if we assume that our sold put expires worthless, then that will give us another $7,770. Those two figures combined would be a total profit of $24,970. Not bad. That ends up being a return on capital of 36.5%, because basically in this scenario, it required $68,300 to put on these trades, and it produced a return of $24,970. All right, so you have all that. Now, let's look at scenario number 2. Now, in this scenario right here, instead of buying the 100 shares, I am going to instead purchase a Leaps call option. The one that I selected actually takes me to December of 2026. That's quite a ways away. But the reason I am doing it that way is I will have the advantage of selling calls against my shares for quite a bit of time. This is called a poor man's covered call. Now, this video will not go over that piece of the puzzle. I just want to show you the leaps and the appreciation that we will be looking at if we do this instead of buying the shares. So if we purchase the leaps that expires in December of 2026, that is actually going to cost us $15,032 if we go with the $250 strike price. Well, let's go look at the $250 strike price and see why I may have selected that one. If you look on the option chain, this is December of 2026, and the reason I selected the $250 strike price for my leaps is right here. You see that it's 0.81. Usually, if you can find a particular call option that is around 0.8, you will be able to maximize the amount of money you're spending to the actual return. And so for every dollar that Tesla moves up, this particular option that I'm spending a little bit over $15,000 on will go up by about $81 for every dollar it moves forward. You see here, this is 0.81. So what you're looking at is you're taking that times 100. And this is the delta. And this helps you better understand the movement of the actual option. And so this will appreciate in time if Tesla continues to go up. But the beauty of this is it's only cost me a little bit over $15,000 instead of the $33,000 to buy the shares. Now, admittedly, I'm not getting dollar for dollar at this point. I'm just getting about $81 for every price movement up, but it's so much less capital that I'm using that that's a good scenario. And if you like this, you could actually do something different. You could buy 2 of these for less than $33,000, so it'd be about $30,000. And then for every dollar that Tesla goes up, then this will be going up, your 2 together, about $160 for every dollar of movement. And so that is, instead of taking the $33,000 and enjoying just $100 movement up, you're using less than $33,000 and you are getting $160 for every dollar move up. But just keep in mind of the potential risk for every dollar that Tesla moves down at the point of purchase, then this would also move down the same amount of money. So I want you to be safe. Now, we are quite a bit of ways away, so we have a lot of time for upwards and downwards movement. And if you buy a call option this far out, you usually don't sweat the small movements up and down. Now, let's go to an option calculator and look at what this will be worth if we look at December, so a year before it expires, and we settle in on that 505 level, because this is where we talked about selling our Tesla shares, that is going to produce an additional $12,300 in appreciation. Now, if you prefer, at this point, even though we are a year away from expiration, you could go ahead, since you bought this initially, you could sell it and enjoy an additional $12,300 for each particular one if we're at about 505 in December of 2025. If not, you'll just hold on to it and you'll potentially keep selling poor man's covered calls against it and enjoy the appreciation all the way into 2026. Now, for part 2 of the equation, we are going to go and sell a put to raise more capital. But this time, instead of using a cash secured put, we're going to actually use some margin to sell the put. And let's see how that changes this entire return on capital scenario. Here we are in my Fidelity account, and you can see here that I have margin, but I'm not using a lot of my margin. And so if you look to see here, this will show you that my margin buying power is 2.8 million. My non-margin buying power is 1 million in cash. This is what's not tied up in trades right now. And so obviously I'm just using a fraction of margin right now, which is good because I want to stay safe. And so we're going to put this on a calculator so we can see that instead of actually using cash to sell the put that I was helping to use to generate some additional income, we're going to use margin, or at least a portion of margin. And let's see how that changes our scenario. If we use the same strike price and expiration date, here we go, 350.7635. Let's go put that in the margin calculator to see how much margin it would take. Now, keep in mind, if we're using cash, it's going to be $35,000 that it's holding out of our account. If you add this and you do recalculate, it's going to show you how much margin in cash is required. So let's go look over here. Here we can see that it reduces my non-margin buying power. So here's my cash. It reduces it by $5,782. So that's how much cash will be reserved for this play. Now, I have quite a bit more in margin right here. Now, it will reduce my margin by $8,235. So I'm going to show you two different returns. One is just considering the cash that's being used because that's comparing apples to apples. So in the other scenario, when I did a cash secured put, it was requiring the full $35,000 in cash. But here, it's only requiring a fraction of the cash because it's pulling from a lot of margin. But still, when you add these two together, it's not $35,000. So I'm going to show you both scenarios. I'm going to show you just using the cash that it's requiring, and then I'm going to do the return when you add the margin and the cash together, just so you can see, because even though this is not my cash, it's basically free borrowing power at this point, it still is reducing my available margin. So I wanted you to see both scenarios so that you can have, how this works. And let's go put all of this together so we can get a better idea of what scenario might work out best for us. So going back to the initial scenario, we actually purchased 100 shares of Tesla. We used cash to do so, but to help finance that purchase, we sold cash secured puts. Well, when you look at the cost of doing that, it required $33,300 to actually buy those shares. And then because we were selling a cash secured put, our broker withheld $35,000 so that we could enjoy that premium that we received. So we received the $7,635 in premium. And once we sold our shares, when they got to 505, that gave us $17,200. So it took $68,300 to produce $24,970. That is a 36.5% return on capital. Now that's pretty impressive considering that the S&P 500 on average will give about 8 to 12% annually. So look how the scenario changes when we actually buy a call option versus purchasing the shares. and we go ahead and sell a put option using partial margin instead of just cash secured margin. Well, that changes things dramatically. Now, when you're looking at the 20,814 capital, that is breaking it down by looking at the amount of cash that was pulled out of our broker because it used partial cash. It used $5,782 in cash, and the rest was margin. So it just took that $20,814 in cash to produce $19,935. And what you're looking at there, you're looking at the appreciation of the call option we purchased. Once it gets to the 505 level, you're looking at that plus the amount that we received in premium when we sold the cash secured put. Putting that all together, that gives us a 95.8% return on our capital. Now, that is super impressive. And the last scenario is basically the second one, but I went ahead and I added in not just the cash that was used, but the margin that was used as well. Because you might want to look at it, calculate it that way, since that margin can't be used for anything else because it's tied up in this particular play. So for that dynamic, when you add the margin back in, it's $29,049 in capital produced $19,935 of a return. That's 68.7%. So the moral of the story here is it will be a lot more cost effective for you to use a combination of buying a call and using margin to sell a put than it would be to buy 100 shares of a stock and to use cash to do a cash secured put. I hope you found that helpful and you were able to use this knowledge to actually grow your revenue and grow your account size. I have offered hundreds of trade setups in the last several months, and they have turned out to be such a blessing for everybody. We have made a lot of money operating the wheel strategy. As you can see, here are just some of the plays over the last few months and what they produce. Now, of course, I'm not showing the exact plays because that is reserved for people that are in my community. But if you are interested in seeing all of my trade setups, we do this all week long. We would love to have you. Click the link below and you can join us. And if that's just overwhelming for you and you want to start small and start slow, then consider my new trader network. That's a growing community too. So happy to have all of you. Remember, if you are trading with Ashley, there is no trader left behind. Happy Thanksgiving, everybody.